Hello, I am Chemoze. Welcome to the weekly market notes program. This week, the markets diverged sharply, as if operating on two different planets. On one side, a wave of risk aversion driven by global uncertainties and concerns over the US credit markets pushed gold to its strongest performance since the 2008 crisis, with an 8.5% weekly gain, reaching a historic high of 4,878. On the other side, this same risk aversion wave hit cryptocurrencies like a tsunami, driving Bitcoin down to 103,600, its lowest level in recent months. So, are the markets pricing in a black swan event? Let's delve into the dynamics, figures, and expectations behind what happened this week. The week's global agenda was shaped by a duel that pulled investor psychology to two opposite poles. On one side, the rekindled US-China trade tensions, and on the other, the credit market issues circulating through the veins of the US financial system. These two main tensions set the stage for sharp fluctuations in the markets. At the beginning of the week, China's move to tighten control over the export of rare world elements vital to the technology and defense industries suddenly raised tensions. However, the strategic reason behind this move was China's desire to manage short-term risks in its economy and to use this leverage as a bargaining chip. Toward the weekend, President Trump softened his tone by stating that high tariffs on China are unsustainable, providing some relief to the markets. Still, the date of November 1st continues to be closely watched for potential new developments. The real shock came from regional banks in the US. The disclosure of troubled loans and fraud allegations involving Zion Bancorp's $50 million and Western Alliance's $100 million triggered a domino effect. These news caused the US Regional Bank Index to drop by approximately 5.8% on Thursday. JP Morgan CEO Jamie Dimon's striking comment summarizing the situation further heightened concerns. Where you see a cockroach somewhere, there are probably more. Panic quickly crossed the Atlantic. In Europe, Barclays and Deutsche Bank shares lost more than 6% in value, and over £1 billion were wiped off the European banking index in a single day. The seriousness of the situation was also confirmed by IMF chief Kristalina Georgieva, who said that risks in the private credit markets are keeping her awake at night. Georgieva's concern points to the non-bank financial institutions (NBFIs) market, which emerged after the 2008 crisis, carrying risks from banks' balance sheets, being less regulated, and reaching massive sizes. The events at Zion's and Western Alliance are seen as the first cracks appearing in this enormous system that the IMF fears. Analysts note that this is not yet a systemic risk affecting major banks. The problem mainly stems from structural weaknesses in the business models of small and regional banks, caught between the pressure of large banks' market share and competition from financial technology companies. What caught my attention this week was the stark contrast between the market's exaggerated reaction to regional bank news and the solid balance sheets of large banks. During panic moments, everything is usually lumped together, but it appears that the overall system currently has the strength to withstand this shock. This global storm of concern naturally also directly affected the US stock markets. Despite all these negative news flows and the sharp sell-off on Thursday, the S&P 500 index closing the week positively was notable in demonstrating market resilience. The index finished the week with a 1.7% gain, marking its best weekly performance since August. There were three main reasons behind this surprising rebound. 1. Trump's comments easing tensions with China. 2. Strong earnings reports from major banks exceeding expectations. 3. Dovish tone messages from Fed Chair Powell emphasizing the labor market and strengthening expectations of a rate cut. Technical levels. Analysts are watching the 6,500 level as an important support, and the 6,700-6,750 range as a short-term resistance for the index. The performance of the S&P 500 this week shows how quickly the market can digest bad news and how it is eyeing a possible rate cut from the Fed. Although risk appetite seems weak, bottom fishing opportunities are also being watched. This positive atmosphere in the overall index was even more evident in the Nasdaq, where technology stocks have a significant weight. The Nasdaq index performed better than the S&P 500, powered by mega technology stocks and the artificial intelligence theme. Concerns in the credit market barely affected tech giants. The index closed the week with a 2.5% increase at 22,680 points. Leading this performance were the quarterly earnings of chip giants like TSMC, which exceeded expectations, and the ongoing appeal of the artificial intelligence story to investors. Technical levels. The index is supported at 22,000 points, while around 23,000 points stands out as an important resistance zone. Next week's earnings reports and guidance from major technology companies will determine the index's direction. No matter how much fear exists in the market, the story of artificial intelligence acts like a stronger magnet than anything else. The expectations surpassing figures from giants like TSMC confirm the strength of this theme. The common question in global markets is, are we in the dot-com bubble of 1999? My question, however, is different. What if we are in 1996 and have yet to see even half of this technological revolution? While this divergence occurs in risky assets like stocks, the bond market, which reflects the market's true risk perception and interest rate expectations, was quietly but profoundly signaling important messages. Although US bond yields are not in the headlines this week, they continue to be a critical indicator for the future direction of all markets. The trend of yields directly affects the valuation of all assets, from stocks to commodities. Analysts are particularly pointing out the sharp divergence that has emerged since 2022 between US 10-year Treasury yields and industrial precious metal prices. This disconnect among asset classes is interpreted as a signal of an excess or anomaly in the markets. Similarly, the approach of the gold-oil ratio to black swan levels during the pandemic confirms this excess. While everyone is talking about stocks and gold, professionals are watching the bond market. Current indicators suggest an unusual disconnect among asset classes. This whispers that something will need to correct somewhere. The most striking examples of this anomaly and excess theme in the markets occurred this week in the commodity markets. The commodity market has indisputably become the go-to destination for global risk aversion this week. Especially precious metals have served as a true safe haven for investors, witnessing historic movements. Gold had an almost flight week. It recorded its strongest weekly gain since 2008, with an increase of nearly 8.5% on a weekly basis. On Thursday, it rose close to 3%, surpassing the 4,225 level and renewing its all-time high of 4,378 during the week. On Friday, profit-taking caused a slight pullback, and the week closed at 4,213. Technical levels. The short-term support is at 4,200, and the peak of 4,170 seen during the week is monitored as the first resistance point. The volatility in silver was even more severe than in gold. The ounce price exceeded the 52.5 threshold during the week, reaching a record high of 54.47. However, this record was followed by a decline of over 6% within the same day, dropping to 50.96. The week closed around the 86-point level. This extraordinary volatility was a result of both strong industrial demand and speculative selling from the peaks. Technical levels. The 50 level is a critical support, while the 54 to 55 range stands out as a resistance zone. These movements in precious metals have now shifted from a risk aversion to a speculative frenzy. Especially the 6% drop in a single day in silver serves as a warning of how dangerous it can be for latecomers to this train. Contrasting this exuberance in safe havens was the biggest loser of the week, the cryptocurrency market. The heaviest toll of the decline in global risk appetite was borne by the cryptocurrency market. This week, as investors flocked to safe havens, digital assets suffered deep losses. Bitcoin, BTC. With a sharp sell-off, it dropped to $103,600 on October 17th, reaching its lowest level since June. Although it tried to stabilize around $105,000 for the week, it experienced significant losses. Technical levels: $100,000 psychological support, $110,000, $115,000 resistance. Ethereum, ETH. Similarly, it experienced a week of selling pressure. It declined to 3,764, recording a decrease of over 6% on a daily basis. Technical levels: $3,700, $3,500 support, $4,000, $4,200 resistance. Ripple, XRP, one of the biggest losers of the week, it fell by 7.5%, dropping to 220. Technical levels. This level turned into resistance after breaking the important support at 2.47. Below, psychological support is critically important. What happened this week has once again questioned Bitcoin's digital gold thesis in the short term. As fear increases, investors rush to gold while fleeing Bitcoin. However, looking at the bigger picture, this situation may simply be a temporary shift in global liquidity. The Global Liquidity Index indicates a potential turnaround from the bottom and a rally until the end of November. This money may currently be flowing into gold, but eventually it will return to risky assets like cryptocurrencies. Therefore, the current strategy should be to stick to stop-loss levels instead of panicking and wait for the liquidity wind to change direction. Cryptocurrencies are still considered high-risk technology investments and need to be managed with discipline. This stormy weather in global markets has also negatively affected the domestic markets, influenced by both external and internal dynamics. Turkey's markets spent the week under the pressure of both a global risk aversion wave and changing expectations following inflation data that exceeded domestic expectations. Borsa Istanbul continued its negative trend, closing the fourth consecutive week with a loss. Performance. BIST 100 index completed the week with a 4.97% loss, ending at 12,076.76 points. During the week, it declined to 10,053.74 points, testing the critical support level at 10,000. Technical levels. Analysts are monitoring the support levels at 12,200 and 12,100, while resistance levels are at 14,000 and 15,000. Agenda. The upcoming CBRT meeting and the messages conveyed will be crucial for the market direction. The BIST's selling pressure deepened, especially after the postponement of interest rate cuts following inflation figures that exceeded expectations. Previously expected rate cuts in October are now turned into a pass scenario, and any possible cuts seem to be delayed until at least December. Markets will have difficulty finding their way until they hear a clear message from the central bank. The weekly snapshot of Turkey's economy in the triangle of foreign exchange, interest rates, and risk premium showed the coexistence of different expectations. USD-TRY, the exchange rate closed the week at around 41.95, renewing its historical high. Since the beginning of the year, it has increased by over 18%. Technically, 42 is a psychological resistance, and 41 is monitored as the first support in possible pullbacks. Bonds, short-term and long-term interest rates diverged. The two-year benchmark bond yield increased by 59 basis points to 40.2%, while the 10-year bond yield remained flat at around 32%. This divergence indicates increased short-term uncertainties. CDS, Turkey's 5-year risk premium, CDS, rose slightly by 3 basis points to 246 basis points, but staying below the 300 threshold indicates that risk perception remains under control. We see the clearest example of the deep divergence in the market here. On one side, domestic investors are increasing their foreign exchange deposit accounts, especially through gold, thereby strengthening the dollarization trend. On the other side, these same investors believe in the high interest rates by purchasing record-high TL government bonds. While the dollar hits new records, the calmness of the CDS completes this equation. There are essentially two camps in the market, one betting on the exchange rate going up, the other on interest rates generating returns. This contradiction will be the most decisive tension in the upcoming period. After the busy agenda of the past week, all eyes are now on the critical data and meetings scheduled for the coming week. Next week will be filled with critical developments that will determine the direction in both domestic and global markets. Turkey, Central Bank Monetary Policy Committee meeting, October 23rd. Following the high inflation data, this will be a meeting where the market no longer expects a rate cut and the likelihood of a hold is predominant. The decisions and messages in the decision statement are critically important for TL assets. USA Fed meeting, October 28-29, Fed Chair. Powell's recent dovish statements have strengthened expectations of a rate cut. This expectation is the most important factor supporting global risk appetite. USA earnings season, results from major technology companies and their guidance for 2026 will be decisive for the performance of global stock markets, especially the Nasdaq. Geopolitical agenda, trade diplomacy between the US and China and possible new developments on November 1st have the potential to increase or decrease market tension. This week, the most critical event for me will definitely be the central bank's interest rate decision. The message they deliver will not only indicate the interest rate, but also demonstrate their determination in fighting inflation and will shape the short-term fate of TL assets. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week. I wish you a profitable week.